Subscribe. Ding. So how do you qualify for a mortgage?
Approved.
Well, let me tell you, it's like going on vacation for the first time. There's a lot of confusion, some accidental selfies, and at the end of the day, you're just hoping somebody's gonna help you.
God help me, please.
But what if I told you there are some insider tips that could make the whole home buying process smoother than Skippy's peanut butter on a peanut butter jelly sandwich?
Yummy.
I'm talking tips like where to get a free copy of your credit report, how to beef up your credit score, and how to use that report to figure out your debt to income ratio. Because yeah, that's a thing. Oh, and how your job history affects whether you get a welcome home doormat or just a big old nope from the bank. Stick around, my friend, because not only am I dishing out these nuggets of wisdom, but I'm also gonna reveal a little trick that could save you thousands on your mortgage. Thousands. It's a lot of tacos, y'all. Let's jump in. You can actually your interest rate. First up, what's a mortgage? Besides being a word that strikes fear into first-time home buyers, it's just a fancy term for a loan to buy a house. Simple enough, right? But how do you know if you qualify? I call these the big three: your credit score, debt to income ratio, and your work history. It's like the holy trinity of home loans. Today we're breaking them down, side guy the mortgage guy style, so it's easy to understand, even if you're running on 2 hours of sleep and a can of Red Bull you bought at a shady gas station. Let's kick it off with your credit score. It's basically your financial report card. You remember those, right? But instead of your mom grounding you for a C-, a low score can mean no house for you. Ideally, you want to be sitting pretty with like a 700 credit score or higher. But here's the thing. Most banks will approve you with a 620. In fact, I work with banks that'll nod their heads at a 580. But let's be real, you don't want to be skating by on a D-. So shoot for a 620. And here's how you can do it. 1, keep your credit utilization below 30%. Why? Because if you're out here maxing out your credit cards, it's like showing up to a buffet, stacking your plate too high, and it looks bad. And people start questioning your life choices.
Yo, bro, stop. I'm trying to lose weight, bro.
And by people, I mean the banks. So keep that credit utilization below 30%, and you'll be in good shape.
I'm trying to lose weight, bro.
2, avoid applying for new credit. Why? Imagine you're already juggling a few balls. Then you decide to add a chainsaw to the mix. Bad idea, right? Same with credit. Adding new accounts can throw off your balance. Just hold off until you got that mortgage squared away, and you can start juggling all the chainsaws you want. 3, pay your bills on time. Why? Because the last thing you want is a late payment knocking down your score, and paying your accounts on time in full each month is a good way to show lenders that you're a reliable borrower, which makes the banks more comfortable with letting you borrow their money. Make sense? These 3 tips are easy to follow and can make a big impact. Of course, if you just Google tips to improve your credit score, you'll find plenty of additional advice online. You might also consider hiring a reputable credit repair expert. Just be sure to interview a few and check out their reviews because this is your credit score. It's just too important to mess up. All right, let's move on to your debt to income ratios. Sounds fancy, huh? All it means is that the bank wants to make sure you're not spending money like a rapper in a music video. They want to know you can handle your debts, and they do this by calculating your DTI, which I'm letting the secret out on how you can do that yourself right now. Here's what you do. Add up all your minimum monthly payments. I'm talking car loans, credit cards, student loans, whatever you got. Then divide that number by your gross income, your income before taxes, and boom. That's your DTI. Banks like to see it under 36%. Why is 36% so important? Because banks want to make sure that with all your current bills plus your home loan, they would still be getting their money back every month. But hey, I've helped folks get into homes with 50%, so don't rule yourself out. There's hope. Here's a couple of pro tips. 1, get your free credit report. Thanks to the Fair and Accurate Credit Transaction Act, sounds official, right? You can snag a free report every 12 months from each of the big 3 credit bureaus. Go to annualcreditreport.com. It's the real deal, I promise. It's the only website authorized by federal law for free credit reports. Not some shady website promising you free money from a Nigerian prince. So take what's on your credit report and plug that into your DTI formula.
Kaboom! This part.
Now you know exactly what your DTI looks like. And pro tip number 2, once you got that report, check for errors. Why? Sometimes someone has the same name as you and their debts get attached to your report. So get them fixed and then start paying off the small debts on your report first to lower that DTI and increase your chances of that sweet mortgage approval, baby. Now let's chit chat about employment history. Banks usually want to see 2 years of steady work, but if you switched jobs recently, don't sweat it. If it's in the same industry, you're good. If it's a totally new field, well, that might raise some eyebrows at the banks. Unless you're making more money now. This is where your home loan expert comes in handy, giving you the guidance on what'll fly and what won't. Finally, let's talk about those hidden costs. Closing costs, insurance, property taxes, HOAs. They're like the add-ons at a drive-thru that'll turn your $5 meal into a $15 surprise. But here's the trick. Some lenders have programs that'll help you cover some of these costs, but you gotta ask. Always shop around and ask, y'all got any 0% down payment programs? Or any low money down payment deals? You'll be surprised on what you can get if you just ask. And now for that little known trick I promised. You can actually negotiate your interest rate. Yeah, it's like haggling at a yard sale. Even a tiny reduction can save you thousands over the life of your loan. So don't be afraid to push for a better deal. How do you qualify for a mortgage? Well, in short, you need a good credit score, a low DTI, which I just showed you how to calculate, and a stable job with steady employment. That's really about it. What's next? Time to make a plan. Team up with your mortgage broker. They got all the answers when it comes to buying a home. And if you don't know a mortgage broker yet, guess what? Now you do. Hit me up by clicking the link down below and we'll go over all your home readiness options together. For free. I promise you, completely free. And don't forget to subscribe for more home buying tips. See you on the next one.
Big banks, big things, want a lot of money? I got you. Let me call my lenders, connect you with the vendors. No longer be a renter. Duffel bags dinero, all for the zero down payment, no rent.